What do jobs have to do with my mortgage rate? Right now, they have to do a lot. So as many of us are aware, especially for real estate professionals, we had a lot of inflation in the past year and a half. And the Federal Reserve has decided, hey, we got to try to bring that back down. Since COVID, we released a lot of money into the economy, be that through monetary policy. That's where we lowered interest rates to make it very affordable to borrow money, and fiscal policy. That was all the stimulus checks given out to individuals and businesses. And then in the end, we've ended up with a lot of inflation, and we're trying to fight that. Now, one of the ways the Federal Reserve curtails that, their biggest mechanism that they have, is to raise the federal funds rate. Now, federal funds rate don't exactly tie with mortgage rates. We have another video on that, but they're pretty close. It's a close dance. And so when you see the Federal Reserve raise their interest rates, you will typically see mortgage rates have some way of going up as well. Now, here's the deal. What is the Federal Reserve looking for to lower their rate? They're needing what's called a softening economy. They're looking for the economy to slow down because it's right now very heated up. And one of the big things they look at is job reports and how many jobs are being added. Because jobs historically have been an indicator of if the economy is doing well. If a lot of jobs were added to the economy, that generally indicates the economy is doing well and still rolling. People are spending money, meaning inflation can stay high. One of the theories out there is that the Federal Reserve is looking to essentially break the job cycle, meaning they're looking to see jobs go down and have fewer jobs created. And this past Friday, what we saw is economists were expecting the U.S. economy to add 170,000 jobs. And the jobs report came in and blew away those numbers. We added nearly double that at 336,000 jobs. And then they revised the previous, July and August statements upward, meaning more jobs were added than even expected. So the Federal Reserve, all of a sudden, they're looking at this going, holy cow, we're trying to slow down the economy to rein in inflation, and jobs are going like crazy. So then all of a sudden investors, this is where the mortgages come in. And so if you're wondering for clients, why are our rates going up? Investors were anticipating, going off the estimates, that the economy might be cooling down, but the reports are showing otherwise. So now that has spooked and scared a lot of investors to go, oh my goodness, jobs aren't slowing down. That means the Federal Reserve is really going to continue to try to bring them down in the long run. That means that rates might not be coming down for quite a while. So all of a sudden, mortgage rates went up. Why did those mortgage rates go up? Because think of it, if you were investing and buying a mortgage as a security, which is what happens, most lenders are selling those to the big government-sponsored entities, Fannie, Freddie, or private investors. Even banks that are doing the loans, they're selling them off or they're holding themselves as investments. As an investor, you need a return on that money. And if all of a sudden now you're like, hey, rates aren't going down for a long time from the Federal Reserve, that means we need to keep our rates higher and elevated as well. So in simple math, what does that mean? Mortgage rates go up. And that's what we saw this past Friday and over the whole past week, where we saw economic data showing a stronger economy than expected, pushing up mortgage rates. Now, is the economy really doing better? I don't know. Personally, I'd argue, having my background in economics and in finance, I would say that we might have already passed some of that. The economy, those are lagging indicators, meaning they're indicators that we look at after the damage is already done. And so some things may already be changing, but we're not going to see it necessarily in the numbers for a while. That wouldn't be surprising to me. But as of right now, the Federal Reserve is going heavily off lagging indicators. And what has happened, they're looking at things after the effects have occurred. And that means right now, keeping rates higher for longer. My name's Evan Kaufman, your VA loan originator. I hope this helps you go out there and win a home with a VA loan and help your clients if you're a real estate agent. Take care. Bye-bye.